Hello, and welcome to Portfolio Matters, week 117. And it's been quite a week with lots of contradictory data. And I should warn you, this is going to be a long episode as we go back to basics. And I take a long view of the US economy to work out whether our thesis that the US is likely to go into recession in the second half is correct or not. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decision regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, over to you.
Thank you, Richard. Well, news this week. Well, first of all, His Majesty Charles III was crowned last week, and congratulations to him. It was a very good ceremony, I thought. In the US, Donald Trump was convicted of sexual assault, a historic sexual assault in a New York apartment store, I believe, and that seems to have affected his popularity not at all. There were the first talks between Republicans and Democrats on resolving the debt ceiling, and that failed to come to any agreement. We will have a section on the debt ceiling coming up. In the UK, the Bank of England raised interest rates by 0.25% to 4.5%, and it warned that inflation would take longer to come back to the 2% target, but it also upgraded economic growth and said that the UK would escape recession this year. In the US, we had some contradictory data. So last Friday, non-farm payrolls substantially beat expectations, and the market briefly thought that the US economy was doing just fine, and stock markets rallied and bonds fell. But then we had the inflation report, which showed that US inflation was coming down in part because the economy appears to be slowing. We will be having a deep look at the US economy in due course. And finally, this morning, Ukraine appears to have launched an attack south of Bakhmut. Now, we don't know whether this is the spring counteroffensive, but we will find out in the coming days. Okay, some charts related to the news. Well, this is the US 1-month yield, and you'll see it has shot up. Investors are concerned about holding short-term US bonds because of the fear that there will be a default, a technical default, and they won't get paid on time. And the Fed has succeeded in its aim of having positive real interest rates. So the US interest rate, so Fed funds minus the inflation rate implied by the bond market, is now positive for the first time since 2018. And we're going to have a special section on the debt ceiling coming up. But the Biden administration has not been following the classic Keynesian policy of counter-cyclical fiscal policy. So during the good times, you're meant to try and run a fiscal surplus to build up funds to spend them when the economy is not doing so well. This time, the US economy is arguably at its peak this cycle, but the fiscal deficit is running at 5.4%. And long-term viewers will remember the Kalecki-Levy formula, which states that corporate profits are a function of government deficits. The bigger the government deficit, the higher corporate profits. Now, we've been surprised by the fact that corporate profits have been so resilient this year. Well, that can be explained by the Biden administration spending lots of money. So, reminder, this hiking cycle has been very rapid by historic standards, and those higher interest rates work on a much enlarged debt stock, which will stress highly indebted borrowers and financial institutions exposed to them. Now, moving to the UK, this is the Bank of England's latest inflation projections. A wry smile. As we turn to the comedy chart. So
it is sad, isn't it? You know, degree of incompetence significant.
Yeah. Well, we'll skip on without comment.
Richard will start this way.
Now, this is interesting. So this is the UK's inflation. So the red line is CPI, food and non-alcoholic beverages. And the blue line is the change in agricultural prices. And you'll see normally agricultural prices rise more than food inflation because manufacturers and retailers absorb some of the increase in costs. This time, it's been the other way around. They've taken the opportunity to increase their margins.
So I think what's happened here, Keith, is that the official statistics for measuring inflation over the last many years have actually undermeasured inflation. And I think that's deliberate policy. And everybody is very well aware that they are actually significantly worse off than they were, let's say, 10 years ago. And this is an ideal opportunity to put themselves back where they feel they should have been. And I just think it's like a quiet rebellion underneath the surface of people saying, we're not prepared to put up with this anymore. We're going to revert to how we were.
Well, you know, companies and individuals can't all try and raise their wages. It's a zero-sum game. And the Bank of England needs to break this cycle, basically. And
with respect to the Bank of England, they don't understand what the cycle is. That's their fundamental problem. They don't really seem to understand what it is that they're trying to address.
Well, I tend to agree with you, Richard. We'll go through this. We will discuss this further as we go through the data. So this is the Bank of England's latest UK GDP forecast, and they've substantially upgraded the UK's prospects. But I would observe that the UK is a very open economy and is exposed to the rest of the world, trends there. And as you'll see, I don't think the rest of the world's going to do very well. So I really wonder whether the Bank of England has got a bit carried away by good first quarter UK data. Okay, on to this week's economic data. So in the UK, we had construction PMIs for April, and they were pretty much in line, but still in expansion territory, which is surprising. Retail sales also beat in April. Now, we've just had this morning GDP data for March, and it was disappointing, down 0.3%. So the Bank of England, for some reason, thinks the UK economy is going to be recovering in the second half. Year on year, growth was 0.3%, rather disappointing. Industrial production actually bounced back a bit in March, up 0.7%, which was better than expectations, although year on year, industrial production fell 2%. Moving to the EU, we had construction PMIs for April, and they slightly beat expectations, but still show contraction. EU retail sales for March disappointed, down 1.2% month on month, and year on year down 3.8%, also disappointing. Now, all the big data this week was from the US. So last Friday, after we recorded Portfolio Matters, we had non-farm payrolls, and that was a substantial beat. So it was expected 180,000. It came in at 253,000. And once again, the US labor market is surprising to the upside, and it shows that the jobs market there remains tight and the US is still creating jobs. We have a special section on that coming up. The unemployment rate fell to 3.4%, the lowest in many, many years. And weekly earnings beat expectations, rising 0.5% month on month and 4.4% year on year. So wage inflation appears to be persistent as of April in the US. And that data led to equity markets having a bounce and bond markets having a big sell-off, as it appeared that inflationary pressures were persistent. The hours worked were flat. Used car prices in April fell, and they had been rising. We'll show you the chart in a bit. Now, the survey of US consumers for May came out, and that was a big negative surprise. So it was expected at 48.2, up on April. In fact, it collapsed to 41.6, and that is very poor. The National Federation of Independent Businesses, i.e. small businesses in the US, their business optimism index declined in April, missing expectations, and came in at 89. Then this week we had US CPI, and that came in pretty much on target. The year-on-year number came in at 4.9%, which was below expectations. Core CPI at 5.5%, meeting expectations. So inflation finally is no longer exceeding expectations. And we'll show you the charts in a minute. Now, we also had some quarterly data. We had UK GDP year on year, and that came in at 0.2%. The UK economy is not firing on all cylinders. Quarter on quarter, it came in positive, plus 0.1%. And business investment bounced back, up 0.7% in Q1. Construction orders, though, and that's data out this morning, massively missed expectations. So in Q4, it was minus 4.3% year on year. In Q1, it's minus 14%, missing expectations. And frankly, given that we know that construction and manufacturing are the sectors that lead the economy into recession, I'm very surprised that the Bank of England is upgrading UK economic growth for the second half. Richard, some charts.
Thank you, Keith. So this is a UK GDP year-on-year quarterly data. What I would say about this chart is probably when GDP is so close to zero, then you only need a small measurement error, calculation error, and you are in fact substantially wrong as to whether you are on this sort of artificial scale of are we growing or are we shrinking. And clearly it's in the, I'm going to be cynical here, but clearly it's in the interest of the Bank of England and others to nudge it slightly up than down. Yeah.
Now, the Bank of England can never say, the economy is going to do really badly, because that has the danger of being a self-fulfilling prophecy as it affects confidence. So they have to relentlessly try and be positive.
Yeah, exactly. This is UK GDP quarter on quarter, which is really very, very sick, particularly as we're trying to grow ourselves out of a funding crisis. Month on month, basically, it's sort of dot and dab, isn't it? One up, one down, one up, one down.
Yeah, but your point, Richard, about measurement errors, you saw the quarter on quarter number for Q1 plus 0.1%. But if you add up the monthly data, that sums to minus 0.1.
Yeah.
Yeah, both from the ONS. What's going on?
The spreadsheet isn't quite right, Keith.
Yeah, you'd think they could get it consistent. Not very impressive, really.
It's not. No, it's a good spot. Okay, new construction orders down 14.3%. I mean, I think this is probably to be expected, isn't it? I mean, the only thing I would say that surprises me is that it's taken such a long time for new construction orders to fade away.
So I should say this is not quarterly data as in the title. It is the change over the past year using quarterly data.
And we have UK industrial production, which is, it looks like an enormous positive bar, but it's only 0.7%. And there's been a lot of declines. So,
yeah, but actually, when you look at the last 6 months, generally, actually, positive picture. Is it sustainable? We ask ourselves.
Yeah. UK industrial production year on year still below zero, shrinking. UK construction PMI, one would expect to see that falling quite rapidly, I think.
I agree.
And UK BRC retail sales, it's still looking positive.
Yeah, surprising resilience from the UK consumer.
Yeah, the average mortgage rate is continuing to go up. It's nearly, 7.5% there, which is, and when you consider that many people have been paying 1.5%, 2%, and they'll be coming out of their fixes, and their interest charge will triple.
Yeah, the strength of the UK mortgage market and the housing market just mystifies me. We know this year, 1.6 million households move from fixed rates at 2% onto the variable rate at 7.5%.
Yeah.
It's going to suck demand out of the economy as the year goes through.
It's going to be like, the potential is that it's like a sledgehammer coming down on the economy. And the EU construction PMI, which is below 50 and staying below 50. EU retail sales falling.
Yeah,
month.
The EU consumer is doing substantially worse than the UK consumer.
Yeah, and EU retail sales year on year in a downtrend. US non-farm payrolls. Take this data in isolation. You look at you think the economy is doing well. Well, it is doing well. You don't see all the turmoil in the background from this data.
No, the US economy continues to show resilience, although I should warn you, we have a section on non-farm payrolls coming up, and the data may not be all it seems. In particular, they have revised downwards their last 3 months data.
Right. The US unemployment rate, which is very low.
Now people see the very low unemployment rate and they say, the US economy is doing very well, which it is, but it's really got nowhere to go now because everyone capable of holding a shovel has been given one. And a lot of people who are really not very good employees are in work. So historically, when you see very low unemployment rates, that means the economy is running out of spare capacity.
Good point, Keith. And average hourly earnings have jumped in April significantly, highest since July last year.
Yeah.
And US average hourly earnings year on year, 4.5%. Doesn't look like it's going to drop much lower than that, which sort of puts a floor under inflation.
Yeah, unless you get some slack in the labor market. And frankly, there is little evidence of that so far.
Yeah. US forced labor participation rate. Sorry, labor force participation rate is starting to, it's sort of nudging up against the lower end of the participation rate in the middle of the last decade. And average weekly hours worked is falling, continuing to fall, although the scale is a very expanded scale.
Yeah. So, but the surge in hours worked post-COVID has completely faded. I mean, the thing you could say is it's back to normal.
Yes. US CPI month on month, so it's sort of looking like it's sticking at around about 0.4, 0.5%, doesn't it? Monthly. And there's year on year. Question is it going to settle down between 4 and 6%?
Well, I think it's going to fade further. We've got a section on this coming up, Richard, and remember that shelter is lagging and shelter is dragging this up.
Yeah. There we have core CPI for the US, which is not falling particularly quickly.
Yeah.
5.5% or so. US PPI year on year is dropping very fast and continuing to fall, as is core PPI, higher than PPI, but still falling fast. US business optimism index is continuing to drop.
Yeah, this is small businesses.
Yes. And the economic optimism index is basically in a sort of noisy choppy downtrend.
Yeah, so this is a survey of US consumers, and there was a big drop in May.
US used car prices, sort of, it's probably going to return to the mean, isn't it? And wipe out the big changes that we had in the last few months. There's a big drop, though, suggests demand has fallen off substantially, or more parked cars coming onto the market.
Well, I think what's happened, Richard, is that in January there was a surge in demand and dealers bought a load of cars, and now demand is not coming through, and they're going to have to reduce inventory.
Yeah. Year on year, used car prices probably stabilizing. Difficult to tell exactly from this graph.
It is, yeah.
And Johnson, Red Book retail sales, I mean, just on this really relentless downward trend that shows no sign of breaking, which, I mean, at some point, this has to feed through into the economic data as well, one would imagine.
Yeah.
And the US mortgage rate steady at around about 6.5%. And the US mortgage market index steady at around about 200 now. It's been there for the last 6 months or so.
Yeah, but that's a very low level.
Yeah. Initial jobless claims higher.
Yeah.
Contradictory, the non-farm payrolls.
Yeah. So this is data, latest data this week. And is that the breaking of a trend? Are unemployment claims now rising in the US?
If you go from January 2023, there is a clear upward trend forming.
Yeah.
Continuing jobless claims have stabilized after rising quite significantly from late last year, the autumn of last year.
So again, contradictions, big jump in initial jobless claims, continuing jobless claims going nowhere. Although, of course, that will feed through over time.
And if people aren't, and also suggests that people aren't dropping out of continuing jobless claims, i.e. they're not getting a job.
Yeah.
Which slightly contradicts the tightness of the employment market. So,
yeah.
But it may be that we're at an inflection point, and therefore the data is a bit contradictory because there's change going underneath the surface. Or it may not be. So US non-farm payrolls, I mean, basically what we're saying here is that there seems to be quite a lot of contradiction within the payroll data generally, but that the employment market is still very tight in the US, which gives the employment market purchasing power, pricing power, and can feed through into inflation. As Keith says, that US inflation is falling in line with expectations, but super core inflation, which is without shelter, is effectively unchanged. US small business optimism continues to decline, a contradiction to what the NASDAQ is doing, actually, out of interest, which is obviously the largest, very few of the largest industries in the US. And the UK economy, I think, is in quite a poor place. I think new construction orders 4.3% down in Q1 is very bad news for the UK economic activity.
Yeah, I think we should have a little wager with the Bank of England, because I think they're far too optimistic. Yeah.
So if they win, they give us gold. If we win, we print some money and give it to them.
Yes. I have a Monopoly set.
Yes.
Okay, thank you, Richard. On to one chart. Now, this is a chart showing inflation in the US in blue and capacity in the economy. Now, I'm not sure how they're measuring that, but the point is that in order to get inflation under control, you need to have some slack in the economy. And really, inflation only comes under control when you create some slack by slowing the US economy into a recession. And right now, the amount of slack has been increasing, but is not yet negative. And in order to get inflation right down, you need to drive the US economy into a recession. And that essentially, although they're not saying that explicitly, is the aim of the Fed. And they've raised rates very quickly. And I expect them to succeed. Okay, so this week, rearranging things, we're going to start off with the Federal Reserve Senior Loan Officers Survey, which came out this week. And what it showed was that lending standards did increase in Q1, but only slightly. Spreads continued to widen. So although lending standards only tightened a bit, banks are increasing the rates they charge. And demand for commercial and industrial loans has been falling. So is that a function of a slowing economy or the fact that it's more expensive to borrow? And lending standards for commercial real estate are very tight and tightening, and demand is very low. Mortgage lending standards are also tightening, and you'll notice that's particularly tightening for subprime. And despite the tightening lending standards and the increase in interest rates, there was a bounce back in demand for mortgages in Q1, which we have talked about at the time and is surprising. Consumer lending conditions are also tightening, and the willingness to make loans collapsing. But again, there was a bit of a bounce back in demand in Q1. Now, tighter lending standards are generally a good forward indicator. So here, the blue line is lending standards for consumer loans, and the light line is lending standards for commercial and industrial loans, and the bars are recessions. And you'll see tightening lending standards precede recessions, and they also precede bankruptcies. So we'd expect to see rising bankruptcies anytime now, frankly. So in summary, the Senior Loan Officers Survey shows tightening lending standards at banks and also declining demand for loans. Now, the question is there any evidence that banks are actually reducing loan growth? Richard.
Thank you, Keith. So what this chart is showing is that the 3-month T-bill yield is 5.25%, and the BAA corporate yield is 5.5%. But obviously, you've got the risk of bankruptcy with the corporate yield, and all other things being equal, which right now they're not. You've got a no risk of bankruptcy of the US government. And what it suggests is that why lend to businesses when you can get effectively the notional risk-free return of 5.25%.
Yeah, absolutely. So, you would expect credit to corporates to be disappearing because, it's just not worth it.
Yeah. And in other words, what is happening is the government is crowding out the corporate sector.
Yes, very good, Richard.
So US bank deposits falling the week ending May the 5th, which presumably is because people have been buying government debt or corporate debt. But I don't know, I never understand this. If for a US bank, for the money to go out of the system, it has to go into the Treasury General account, doesn't it?
Well, this is the point, because we know that after April 15th, that there were outflows to the TGA, but actually the drop in bank deposits was really quite small, much smaller than I expected.
Unless, I suppose the other way the bank deposits can fall is through principal repayments on debt.
Yeah,
the money is extinguished. So loans, leases, And they're still climbing, aren't they? At a slower rate than they were, but still climbing at a much higher level than they were pre-COVID.
Yeah. You see, this is the point, that the loan officers survey is saying that banks are tightening credit conditions, but they're still lending, actually a decent amounts.
Yeah, it's just the lending is more expensive. So there we have a chart shows that they are, as Keith says, they're still lending, and still lending real estate loans as well. As clearly there was a bit of a review going on when I guess people these organisations put a hold on lending or curtailed lending while they reviewed their policies. They've reviewed their policies, they've put them back out, and people are borrowing real estate loans again under much tighter conditions.
Yeah, but we saw from the senior loan officers survey that the banks were reporting A, tightening credit conditions, and B, falling demand. But, you look at the actual data, loans are growing.
A lot of contradictory data. Commercial and industrial loans, monthly change, well, pretty much no monthly change, really.
Well, again, negative. So,
but very slightly.
Yeah, but that matters, Richard. The credit impulse is going to be very negative.
Yeah, true. And consumer loans monthly change, or consumer loans continuing to increase at around about $10 billion a month.
Yeah. The chart, the red line here is deposit growth on the left-hand chart, and you see that is very poor, but loan growth is in line with the median, although well down on 2022. And that means the credit impulse will be highly negative. So that should be bad for the US economy in the coming months.
And the drop in US bank deposits is at a record of people moving into government debt. And money market funds.
Yes.
I believe, although money market funds aren't the panacea that people think they are.
So what do you mean?
Well, because a lot of their funds are is in corporate debt.
Yeah.
And so if corporate debt suffers, then your money market fund will equally suffer. Yeah. So this is US bank deposit flight can only get worse after Apple launched its own high yield savings account, drawing in $990 million in its first 4 days. Gosh. I noticed that Apple want me to pay for my iPhone backup, which they didn't used to do. I refuse on principle.
Very good.
Thereby depriving them of about 70p a month. So the interest differential between money market funds and bank deposits is really enormous.
Yeah, but this is flows into money market funds, actually, Richard, and it's just relentless.
Yes. Yeah. Because
of that interest rate differential.
Yeah. Although, I mean, you have to say though that you would then think it depends on the volumes, doesn't it? But that is buying pressure on US treasuries and corporate debt, which should see the prices rise, the interest rates drop. So it's not just small banks who are sitting on unrealized losses. Well, I can't sound terribly surprised at that. Everyone was saying the big banks are fine, but big banks have got 211 billion of unrealized losses, nearly actually as much as they spend every year on paying fines and penalties. And the FDIC's deposit insurance fund will soon need refilling. I mean, they're talking about whether they should just deposit back up all bank deposits, aren't they? And that basically is Uncle Sam or Uncle Bill Bailey. What's his name?
Yeah. What is his name? Bailey, something Bailey.
Bob Bailey. It's a precursor to them the harbinger of them printing vast sums of money to bail out the banking system. Andrew Bailey. Well done. Got there just in time.
Yeah, Andrew Bailey.
We'll call him Arthur though. Arthur Daly.
Yeah.
Bailey. You have to cut some of this. And this is a chart that says global credit conditions, not just in the US, but everywhere they're tightening fast.
Yeah, but again, you know, when you look at the actual loan data, they say they're tightening credit conditions. They don't seem to be.
Agreed. Yeah. And commercial real estate is expected to suffer steep losses this year. And I think it's fair to say that Keith and I have been saying for a long, long time, commercial real estate is going to be a real problem. And it hasn't been. But now it appears that that particular issue is evolving quite quickly. Yeah. Small banks' real estate exposure. So small banks have a high real estate exposure. That is really problematic for the US. And US households have been borrowing relatively little relative to income as interest rates rise, not surprisingly. The maths don't work so well, do they?
Yep.
Which would result in a slowdown in consumer spending. The US regional bank shares continue to fall. And yeah, I did read, I think I probably might have said last week, so apologies for repeating myself, but I did read recently someone tipping the US regional bank ETF because US regional banks were profitable and stable.
Yeah. We have been quite clear on this podcast. You don't bottom fish in banks.
Yeah. Not even Credit Suisse. PacWest Bancorp shares fell another 22% yesterday on news of further deposit. And of course, this is self-fulfilling, isn't it? Once this happens, it's almost impossible to stop. And presumably PacWest Bancorp will become a subsidiary of JP Morgan fairly soon.
I agree. That's the problem. It's self-fulfilling.
So although the senior loan officers survey reports tightening of credit conditions, loan growth is continuing to look healthy. While commercial industrial loans are falling, credit growth is not particularly. It's not showing any particular signs of ill health. Got a lot of deposit flight. A lot of people very uncomfortable about leaving their deposits in the regional banks, and a fading confidence in regional banks. So the banking crisis is not yet over. How will it evolve? We don't know. We shall have to wait and see.
Yeah, but it's very much ongoing. Watch this space.
Yeah.
Thank you, Richard. Okay, on to the debt ceiling very briefly. So this week, there was the meeting between the Republicans and Democrats, which we discussed in earlier weeks, and it came to naught. So the TGA is now down to less than 200 billion, and the tax receipts from April have already largely been spent. So you had that brief tick up in the TGA, and it's now declining rapidly. And the CDS market is worried about a US default, although if the US financial system goes into meltdown, who's going to pay out on the CDS, he asks. And now this is interesting. So the Wall Street Journal had an article discussing the consequences of a US default. And I'm going to read this out. The Fed's payment system, called FedWire, wasn't programmed for late payments on Treasury bonds. If a bond matured without being repaid, it would effectively disappear from the FedWire system as if it had been paid on time. Billions of dollars in assets held by financial institutions around the world would effectively go poof. The Securities Industry and Financial Markets Association, or SIFMA, has spent the past decade trying to work out a plan to avoid such calamity. But for the plan to work, officials there say they need ample warning from the government of a missed payment. So the consequences of a missed payment from the US government would be difficult to predict. There would certainly be chaos in the financial system. Thank you very much to our Discord member, Eloy, for managing to track that down for me.
I think the point that you made just a moment ago, Keith, as well, about if you've got CDS insurance, and if the financial system implodes, who's going to pay out on those? It's a really valid one. counterparty risk is huge within the financial system. The financial system is incredibly overstretched, and it's it's a very dangerous. It's a very dangerous world at the moment in terms of the financial system. And obviously, if as you say, if the Fedwire system starts to annihilate debt, I don't know what the consequences of that would be.
Yeah,
Really,
absolutely.
I don't know. I mean,
Yeah.
apart from pretty bad.
Yeah, pretty bad, I think is all we can say. Chaos would ensue, and with a big loss of confidence in the US financial system. I mean, and that some of that would be temporary, but there would be a permanent reductions. Well, there'd be a permanent increase in credit risk for the US government.
Huge reputational damage.
Yeah. Now, Andreas Steno Larsen has done the maths, and he reckons that the US is burning through about 160 billion a month. And as of the 10th of May, the TGA had 197 billion in it. So if he's correct, that means that the US government goes bust in just over a month's time. That's the drop dead date. And so we're talking in the second week of June.
Which actually is earlier than we were saying a few weeks ago.
Yeah. So tax receipts have been disappointing.
So in fact, yeah, I mean, the financial situation, which looked pretty dire a few weeks ago, has actually got worse.
Yeah. So, summary, in the immortal words of Sir Alex Ferguson, it's squeaky bum time. And on to Inflation Watch, Richard.
Thank you, Keith. Well, as we all know, inflation is now beaten. The central banks have been victorious. Basically, there's nothing to see here, Keith. Should we move on to the next section?
I wish that were true, mate.
If only. Okay. So the new data that we've got is that US CPI is continuing to fall and US core CPI is continuing to fall. Still high by historic and target standards of 2%. The famous number derived by a New Zealand economist in 1844. German inflation also falling in April, down to only 7.2% in CPI and 5.8% core CPI. And the general trend at the moment, obviously we're waiting for UK data, the general trend at the moment is of a fall in the rate of inflation.
Yeah.
This is a chart showing US services inflation, which has got a little downtick. So it's stopped that relentless upward rise. So the question is, has it finally peaked? And super core inflation, which is core minus the outliers, has...
well, it's actually the key point, Richard, is it's ex-shelter.
Yeah, good point, Keith. Has fallen to nearly zero. So does that mean that that is after a real harbinger of a turnaround in the inflation data in the US? The median and trimmed mean inflation data still very elevated, and whilst the trimmed mean is actually showing a fall, the median inflation is really not. It may be leveling off. Tricky to tell on the amount of data there, but certainly isn't falling yet, and that's at 7%.
Yeah.
And if you exclude shelter, you're seeing you can see the core sticky inflation is dropping quite quickly, and the Atlanta core sticky inflation has stabilized at just over 6%.
Yeah. Now, as we've discussed many times, shelter in the US, this owner equivalent rents, it's a weird measure which lags. And so it means that inflation tends to be underreported initially and then overreported now.
One does wonder why they don't just change it, because it would be much easier for them to manage, or at least they'd be managing on much more accurate data.
Well, yes, exactly.
So there we have that point that Keith just made. And housing is dominating the overall inflation data. And real world rents are falling quite fast, and CPI shelter beginning to turn down. So, the concept here is that we should see this data continuing, this influence continuing on the inflation data for the next few months, pushing it down. And there we have the month-on-month annualized CPI for shelter.
Yeah, so it's coming down. So
the headline, Atlanta Fed wage growth tracker, which is a 3-month moving average, is showing the overall wage growth around about 6.5%, with a 3-month moving average. And when you don't smooth it, it's lower. I mean, moving averages work very well, generally speaking, but you can see here that the moving average basically is chopped off the top and chopped off the bottom. So it's quite, at this point, it's difficult to know where it's going.
Well, the point is, Richard, the latest data is 5.1% in April. So perhaps we are finally seeing wage growth in the US start to moderate, but it's too early to tell.
Yeah. So US M2 is continuing to fall, and year on year, it's quite interesting. If you flip, so year on year, it's a massive fall, but if you flip back to that previous chart, it's a relatively small fall, and that's because M2 is so huge.
Yeah, but of course, what matters is change. I mean, GDP is a flow number.
Yeah. CPI should follow M2 down. It tends to follow M2, so we should see CPI continuing to follow M2 down, unless the velocity of money picks up.
Yeah, but then, if you're raising interest rates and reducing loan growth, it shouldn't do, as long as citizens retain confidence in the currency, he says. Fingers crossed.
Yeah, so true. So UK M2 also falling, but not by as much as in the US.
Yeah, actually not by very much.
No.
So this adds to further evidence of sticky UK inflation, frankly.
So generally speaking, inflation is falling. If you look down the right-hand column, mostly they're lower. Netherlands is higher. France is higher. The Eurozone actually is higher, isn't it? Italy. But a lot of countries are seeing a falling rate of inflation. But who would want to live in Venezuela?
It may come to that, Richard.
And inflation surprises. Nothing surprises us about inflation anymore, does it, Keith?
Well, yeah. But they're coming down, and we saw that with the CPI numbers in the US.
Yeah, quite surprisingly. So there we are. US inflation is continuing to fall, and prospective data suggests that that's not going to change.
Yeah, no, the trend in inflation is definitely downwards.
Yeah.
Okay, on to recession watch. Okay, so this is non-farm payrolls. And if you step back and look at the trend, it is definitely slowing, although non-farm payrolls did beat expectations by a decent number. And economists have been very poor at predicting non-farm payrolls. So the labor market has been surprisingly strong, has beaten expectations for 13 months in a row. Although, when we talk about non-farm payrolls, and we've got a section coming up, actually, these are the headline announced numbers before revisions. After revisions, this isn't right. Now, the supply chain index continues to ease, and that means goods inflation should continue to fall. Moving to Germany, factory orders fell sharply in March. And when we look at the sub-indices, you can see energy-intensive industries in Germany are in real trouble. Credit demand in Europe is also collapsing, which suggests the Eurozone is not doing so well. Now, turning to the US, one of the surprising things is the continued growth in credit card debt, which is about to pass $1 trillion, and the average interest rate on credit card debt is an absolutely enormous 24.4%. Now, in the little box at the bottom, the percentage of US adults with more credit card debt than savings continues to rise and is now at 36%, over a third of the population. And they're paying 24.4%. So that suggests that this rising credit card debt may actually be a function of consumer financial weakness than strength. They're putting things they can't actually afford properly on the plastic. Last week, we talked about the ISM services, i.e. non-manufacturing survey. Then the number was positive and actually bounced last month. But the ISM non-manufacturing is generally more positive than the manufacturing survey and is currently only at around its 23rd percentile of its average reading, its normal reading. So that is a weak number, not a strong number. And you can see that when you look at the graph as a whole. So services in the US did bounce last month, but it's still weak. And if you look at business sales data, then it's falling. And because of that, businesses have been drawing down inventory. And that means orders to manufacturers have been falling. And that trend looks likely to continue. If we look at sales in the US, then generally very weak across all sectors apart from drugs. Notice petroleum. Sales growth is below employment growth. So companies have been adding more staff than they appear to need to fulfill sales orders. At some stage, you can expect them to start cutting that excess staff. Although obviously it hasn't happened yet, as we've seen from the non-farm payrolls. Now, employment growth in cyclical industries, so that's manufacturing and construction, is declining, but is nowhere near the levels generally associated with the start of a recession. So, in summary, the data continue to show an economy declining towards a recession in the second half of 2023, I believe. Now we've got a special sector on non-farm payrolls. Richard.
Thanks, Keith. So the April's non-farm payrolls were strong and unexpectedly strong, I think. And so job creation occurring almost every sector of the economy is on the bottom left here. The only sector that didn't grow was wholesale. And the unemployment rate, as we've discussed, was down slightly, and average hourly wages were up slightly to 4.4%. So rather than the economy slowing, this data suggested that the economy is heating up.
Yeah. Now, actually, when you look at the sector data, Richard, a couple of things that I'd point out are that there's continued job growth in both construction and manufacturing, i.e. the cyclical sectors, very much against my expectations. But also, the government, despite the debt ceiling, continues to add jobs.
Yeah, bizarrely. There were some fairly chunky negative revisions to the job reports of February and March numbers, 149,000. So you can see there the various revisions that were made, combining to the 149,000. I mean, the problem is that 149,000 in the context of the size of the data is significant.
Yeah.
And I'm not sure, I actually don't know how whether the market just discounts that data or it only looks at the most recent data, or whether this gets fed into models and so forth.
The revisions to the non-farm payrolls, you can see the last 3 months they've been negative. Now, that's because the Bureau of Labor Statistics uses a model. And when you see the revisions, these are really substantial. So March numbers were reported at 236. They came in after revisions to 165. Now, the chart we showed you earlier about how the non-farm payrolls keeps beating expectations. Well, when you look at the revised data, it doesn't. And the thing is, the revisions to non-farm payrolls actually seem to have quite good predictive power. So when the labor market is doing well, then the Bureau of Labor Statistics tends to underestimate jobs growth. When the labor market is weakening, it tends to overestimate. And that's what's happening now. So when you look at the revised data, the trend is definitely downwards. And the problem for the Bureau of Labor Statistics is that essentially their survey responses just are in decline. So the black line is the survey response rate, and it's fallen from close to 80% to about 65%. And they have then made these model adjustments, which is the birth death adjustment, which is they're estimating how many new companies are made or died in the US. And that is done on a spreadsheet and a model. And it has become an increasing part of the overall numbers. So when you look at the birth death model month on month, you see they're saying that company formation added 378,000 jobs last month. And that's just an estimate. So 43% of the total was from this spreadsheet. The ADP numbers, in contrast, are from actual payroll data, but they also show April was a good month and that job creation in the US remains pretty strong. And it's also worth noting that 1.2 million more jobs have been created in the US than new employees. So lots of people are doing more than one job, try and make ends meet. If we look at the wider US employment market, then temporary workers continues to decline. And that is a sign that companies are beginning to shed jobs because the easiest workers to get rid of are temps. And that's now negative year on year. And reminder, tightening credit conditions should mean rising unemployment as the year progresses. And small businesses are reducing their expansion plans, and that should mean lower future employment and rising unemployment. So in summary, the non-farm payrolls data showed a strong US jobs market. But when you dig into the details, yes, April was a strong month, but the trend is definitely downwards. And the Bureau of Labor Statistics seems to be overestimating jobs growth. And it would be no surprise if next month they revise the April numbers downwards.
So now we're going to take a look at the US economy in overview to try and get a sense of where it's heading, rather than getting too lost in or go too deeply into the detail. We want to get a bit of an overview of it. Where are we in the economic cycle? So ISM manufacturing and non-manufacturing, they're clearly both slowing, significantly down from their peak, and no sign of a turn, although they do turn quite sharply when they turn. The ISM Purchasing Manufacturers Survey are both in the bottom 20% of their range. This is a chart that shows the range. And yes, so they are weak. So US real final sales to private domestic purchasers, which is effectively what the economy is producing fundamentally to the end user, it doesn't look especially strong. It doesn't look especially weak. It has gone through a patch of weakness. But right now it's pretty much, I would say, in the center of its band from 2000 up to the present day, excluding the COVID extremities. New manufacturing orders look as if they're topping out, but they're certainly not declining. So the percentage change is approaching neutral, i.e. this measure is topping out. And real personal income rate of change from the prior year, it's, I don't know, we say that it's improving. It's not falling as fast as it was.
Yeah, the last few data points have been more positive.
Yeah.
Is that sustainable? Depends on what happens with the economy. But right now, inflation's kind of coming down. Wage growth is, not so bad.
Yeah, true. And then non-farm payrolls, which we've just had a quite long discussion about, which are a very imperfect measure, are high but falling. And the 3-month change in non-farm payrolls is very slowly, it is slowly declining. It's declining back to its sort of neutral territory, really. So we have unemployment claims have bottomed. Are they rising? Well, possibly slightly, but it's not a significant rise in the context of what you'd expect to see if we were moving into a recession. And US initial claims for unemployment benefit, which is, you have to ignore that enormous spike, COVID spike, are low and bouncing around a low point. So we've got some signs of slowing in the manufacturing data, and we've got fewer signs of slowing in the employment market. And I would say that if you look at the overall macroeconomic position in terms of tightening credit, tightening loan standards, obviously the interest rate rises, what's happening in commercial real estate, I think the US economy is slowly moving towards a recession. I think it's moving slower than we expected it to, a lot slower than we expected it to. It's sort of inching its way there.
Yeah. Thank you, Richard. I agree with you.
Yeah. And I do think it's the goal of the Federal Reserve to try and knock it into recession, although they can never say so.
Yeah, absolutely. They need to get inflation under control, as we showed you in the one chart earlier. You need to create some slack in the economy.
Yeah.
And you raise interest rates to reduce loan growth and credit provision. And that's exactly what's happening. And then that slows the economy.
So the only proviso, and it's quite a big one, is that if by increasing interest rates, they break the financial system, or there's a danger of them breaking the financial system, and then they have to backpedal.
Well, yes, but breaking the financial system breaks the economy, and then you don't have an inflation problem.
Well, that's very true, Keith. Yeah, we have a lot of other problems.
Yeah.
But probably inflation isn't one of them.
Yeah.
Yeah, very true.
Okay, now, thank you, Richard. Now, we've shown you this chart before, which I think is a great chart, and it shows how a recession develops according to the data. And so, reminder, the first thing to slow generally is housing, then new orders, then profits, and then finally employment. And so the fact that non-farm payrolls continue strong is not inconsistent with an incipient recession. Now, you'll notice that at the top of this chart, which we've shown you many times before, there is a list of economic indicators, and they're in order. So the ones on the left are expected to show a recession before the ones on the right. Now, we're going to go through those one by one and look at where we are in the cycle of moving towards recession. So first up, housing market. And the housing market certainly has fallen a long way, but then it's bounced back a bit recently. So the housing market would say, actually, recession has been and gone, but we've had a big slowing there. Building permits, again, big fall, falling again now, as frankly you'd expect given the very high interest rates. ISM manufacturing orders, certainly in recession territory, below 50. The long-term view, that's a weak number and a number associated with recession. US consumer confidence at lows not seen since the great financial crisis, although up from their recent lows, but still that's a very poor number. Manufacturing orders declining, but still positive. That's changed from a year ago. New consumer goods orders changed from a year ago. That has actually gone negative. So both of those are declining. Manufacturing production is negative year on year. New orders actually has had a bounce back, but is definitely slower than it was. Industrial production declining, but remains positive on a year-on-year basis. Average hours worked has been declining and is now neutral. US non-farm payrolls still very positive. That's changed from a year ago, declining, but still decently positive. The long-term view, that's very strong employment growth. Personal income shows no signs of decline. Long-term, decent, a good number. CPI remains elevated. So if we summarize all that in a chart, you'll see that the indicators we would expect to turn negative initially as we move into a recession, they are all turning negative. And if we look at where we are on this chart, I think we're somewhere around here. So housing is definitely slowing. New orders are definitely slowing. Profits are also well down on where they were, but are not yet negative. Employment remains strong. So we're somewhere in the middle of this range. Richard, what are your thoughts?
Yeah, I agree with you, Keith. It's quite interesting. I mean, I guess also we have to bear in mind this is an average. It's not no individual approach to recession. Recession is going to reflect the this precise order of change. But we have quite a lot of those factors are neutral or trending downwards. We're not strongly negative on any of them yet.
Yeah, and
so. Suggests that, I mean, we may actually be a little bit looking at the screen a little bit to the left of where you've put your arrow, possibly. But also it depends on what the ultimate depth of the recession is going to be, which we don't know as well, I suspect. So it's, but I think that the trend is in that direction. The force with the Fed is in that direction.
Yeah, and this week. So last week, the Fed raised rates to a new high. So, monetary policy acts with a lag.
Yeah.
You'd expect the effects of that higher interest rates to be slowing the economy further in the coming months.
And of course, they also are fighting fiscal policy because the government is spending a great deal of money. And so possibly one of the explanations for the slowness of monetary policy to push the economy slower is the huge amount of government spending that's continuing.
Yeah.
The average of recession models is now saying that where we currently are, we have a probability of 78% probability of recession as of March. And I mean, I completely concur with that. I just think it's taking a lot longer. It's further down the road. I mean, obviously, I think if the government has to suspend payments, then that's going to be a big push in a recessionary direction. So I don't doubt that we're heading that way.
Yeah. Thank you, Richard. Okay, now, talking about that and the probability of recession, we have some contemporaneous credit card data, which gives a snapshot of how US consumers are doing right now. And this is really interesting. So overall credit card spending in the US, we had a very strong January and February. Now, remember, we talked about this at the time, that there was unseasonably warm weather in the US in January and February. And that may have helped people to go out to restaurants and spend more than they would have done normally, hence the strong spending data. But the effect is definitely now fading, and online spending is well down. If you look at spending on gasoline, well, that's falling. Part of that is obviously due to the price, but that is not positive for oil prices. Demand appears to be falling. Grocery spending has taken a big bath in May. And so more recent data seems to show that US consumers are curtailing their spending on everything, including essentials, and spending on bars and restaurants after this enormous surge in the early parts of the months. That's normalized, as has spending on accommodation. Spending on clothing is weak. Furniture's bounced back. That is consistent with the bounce back in construction and the home market. Building materials, weak. That's surprising given the continued strength of the construction market. Recreational goods, weak. So in some way, it looks like the US consumers are beginning to pull their horns in. Let's see what the data, the historic data, reveals over the next few months. But this is consistent with recession in the second half.
What you're basically saying is your view of the world incorrect? I think it's not incorrect, but it's taking a lot longer to unfold than we would.
No, that's right, Richard. I think I and all the economists, when you look at non-farm payrolls beating for 13 months in a row, the economy has been much more resilient than I expected, but the trends are definitely going in my direction.
They are, but it's very, very slow.
And after all that depressing economic data, some good news. And this is a solar farm in the Gobi Desert. Totally unproductive land. So the Chinese are filling it with solar panels. And this one has a capacity of 1 gigawatt. It's capable of powering 1.5 million homes. And they've got further projects planned in the Gobi, Tenga and Taklamakan deserts. So, they're burning a hell of a lot of coal, but is part of that coal burning to produce solar panels, we ask ourselves.
Yeah, because they need to burn the coal to create the polysilicon, don't we? That's something we covered a long time ago.
Yeah. But anyway, so energy demand in China is growing, but a lot of the new energy demand is being met by renewables. So that is good news. And onto the checklist, Richard.
Thank you, Keith. So I'd say it's been a really weird week for the stock market, actually.
Yeah.
The FTSE unchanged, stocks Europe up 0.6, S&P 500 up 1.7% for reasons which defeat me, and the Nasdaq up 3% for reasons which defeat me even more. Actually, I suspect I don't really understand it. I can't explain why the markets are going up at this point in the cycle. Today we have the Hang Seng down 1.8%, Topics 1%, Bitcoin down 10%. I think there have been a couple of Bitcoin type scares, haven't they, around recently? The pound down against the dollar, although actually, relatively speaking, the pound is doing quite well against the dollar this year. And the euro likewise down against the dollar index. Actually, not really very much changed on the year. And the VIX down substantially, 13%, suggesting that one should be selling the S&P 500 according to that little rule that we're experimenting with.
Well, that's right. So I shorted the S&P 500 when VIX crossed 20 in line with the rule. I'm still short. I mean, this is like beer money just for fun, but the S&P just looks ridiculous, and it's all the Nasdaq. So it's all tech stocks.
Yeah.
And that just can't continue forever. It can continue for much longer than you expect.
Yeah.
But at some stage,
gravity must surely take hold. Surely, yeah, completely agree. So here I have a chart of Bitcoin in dollars. So it's risen a long way from January. Very volatile, as we all know. The S&P 500, 86% of them have reported earnings, and GAAP earnings per share is up 6% year on year. But we all know that earnings per share is a very dodgy measure when it comes to company health, because it's used to further executive remuneration. But profit margins is a bit more indicative. Profit margins are back up.
Yeah, we've been predicting exactly the opposite.
Yeah.
And, I think part of that is a function of the increase in the fiscal deficit, which is, completely, the fiscal deficit should be counter-cyclical, and Biden's turning it pro-cyclical.
Yeah.
And that can't be good for the economy.
No, I agree, completely agree. Tech outperformance has reached extreme levels never been seen before or exceeded for very long. So as we can see where the red circle, previous two red circles are, we had a sharp, or not so sharp in case the first time drop. So, can tech maintain this level of outperformance? And FANG revenue growth has dropped to virtually near zero, which means that it's all multiple expansion.
Yeah.
Which is expectation. And the P of the S&P 500 has no predictive power on a 12-month horizon. I would like to know what period of time this chart is over.
Well, I've got a lot of data points.
Yeah.
So, I found that very interesting.
But it does work on a 10-year view, roughly speaking. So higher P ratios equals lower future returns on a 10-year view.
And the P ratio of the S&P 500 is very high.
Yes. So all the return in the S&P 500 this year has come from tech and consumer discretionary. Energy has performed relatively poorly. And financial actually haven't performed globally that badly. So yeah, it's very skewed market. Where are we in the market cycle? So small caps lead in bull markets, and they're currently lagging, which suggests we're not in a bull market.
Yeah. So basically the equity market is being supported by these huge tech leaders.
Yeah.
The underlying broad mass of US companies are suffering as the economy slows.
Corporate debt levels are really high, and as we have discussed many times before, when these are refinanced, they'll have to be, earnings after interest will be dramatically reduced. And the Fed balance sheet, as we've discussed, is falling again, and there is a fairly close correlation between the size of the Fed balance sheet and where the S&P 500 is. So here we have S&P 500 outperforming financial liquidity, and we're expecting financial liquidity to continue to drop. So,
well, the Fed is cutting its balance sheet, but the TGA account is being run down. Okay, but is almost out now. And the moment they refill the TGA account, they're going to have to issue a load of bonds, and that will suck money out of suck liquidity out of the system. And that would be very bad for the S&P 500 if you believe this correlation, which seems to work.
Yeah, agreed, Keith.
Okay, thank you, Richard. On to commodities and oil. Well, after a very bad couple of weeks, oil bounced a bit this week, but frankly is once more fading. So Brent was up 1.4%, WTI up 1.6%. In Europe, Dutch natural gas futures fell 2%. UK natural gas futures were essentially flat. US natural gas futures had a little bit of a bounce, up 5% on the week, but still down 51% year to date and at very low levels in absolute terms. Coal had a really bad week, down 8.4%. down almost 60% on the year. And after a great week last week, uranium dipped by 0.6% and is the only energy commodity up on the year, up a decent 9%.
Yeah.
Numbers specific to the oil market, well, although the oil remains weak, actually there are continued inventory draws in the US, which is surprising. So the US oil market is undersupplied, but releases from the SPR are fully supplying it. But obviously you can't run down the SPR forever. The US crude production was stable at 12.3 million barrels, its recent high, and the Baker Hughes rig count ticked down by a further 3. So this is Brent. It had a bounce and then that's fading again. And that is generally a weak looking chart. And when we look at US oil demand growth, that trend is weak. So if we have a recession in the second half, then I would worry about the oil price. These are EU natural gas futures continuing to gently decline as we leave winter and gas storage levels are already extremely good. These are UK natural gas futures, very similar. US natural gas prices, have they finally found a bottom? Coal drifting off still. Uranium, it has this history of short, sharp spikes though.
Yeah.
So commodities, industrial commodities, Richard.
Keith. So aluminium had a bad week, down nearly 4%. Cobalt unchanged. Copper down nearly 5%. I think there's some concern about whether China is going to grow as fast as people were hoping it was going to. And that has had an effect on these. Iron ore pretty much unchanged. Those lithium carbonate had a good week, having been really knocked for 6 this year so far. And neodymium oxide didn't change very much. Nickel, a very poor week, down substantially this year. Tin down a chunk. Ferrovanadium not performing very well this year, and zinc likewise not performing very well this year. So basically, if you cast your eye down the year to date, you still see that industrial commodities are pretty much all down apart from tin. Year to date.
So the pattern we've seen over the last few weeks is continuing. Industrial commodities are fading. And so what's that saying is that the Chinese economy is not doing as well as the market had been anticipating.
Yeah. So we have aluminium, cobalt, copper. Dr.
Copper is not looking too healthy.
Although in the long term, there is still a supply deficit in future years.
Yeah, absolutely.
This is a reflection of immediate demand. Chromium, iron ore, lithium, neodymium, nickel, tin, ferrovanadium, in the doldrums, zinc, and precious metals. So gold still holding itself above the $2,000 level, down a little bit on the week, 10% up year to date. Silver, a big drop on the week, and about break even year to date. Platinum up and about break even year to date. Rhodium really having a bad year. That's impacting rhodium demand if it's not exhaust catalysts. And palladium bouncing around.
Yeah.
So we have gold, which is hovering around its highs. Silver, which had an upthrust and is falling back. Platinum, around about its highs, recent highs. Rhodium, basically unloved. Palladium.
Thank you, Richard. And finally, on to rates. And in general, a poor week in the UK with rates continuing to rise. Now, part of that is happening this morning when there's a renewed sell-off. So you've had falls at the short end, but rises at the long end. So the market appears to be worried that the UK does not have inflation fully under control. In contrast, in Europe, rates fell this week. And so the UK is unfortunately an outlier. Richard, any changes to your views on assets?
No, I don't think so, Keith. Bearing in mind that I don't trade, I'm taking a long-term view, and I haven't changed my long-term view. Just sort of sitting with the fluctuations of the market. How about yourself? Any change?
No.
Yeah.
Okay, so concluding comments. Well, lots of data this week. The US inflation looks like it is falling and on a path to return to 2% in the medium term. US economic data continues to generally slow, although non-farm payrolls beat expectations. The general trend is definitely downwards. The big thing to look out for, though, is the US debt negotiations. So we've seen earlier that on current trends, the US government may run out of cash as early as the second week in June, and that is not very far away.
So, Keith, I haven't had any activity at all this week. Nothing really to add on what I've said over the last few weeks. How about yourself? What have you got up to this week?
Well, I had a roller coaster week. UK long bonds sold off hard after the non-farm payrolls. And then after the inflation data came through, they bounced back and actually ended up 0.2% on the week, having looked really not very clever earlier in the week. And hence, one of the reasons I did this deep dive into the US economy was to try and check whether I was right, that the economy did look set to go into recession. And, reminder, the whole thesis of my trade is that it's cyclical, that I'm expecting the economy to slow down. As it slows down, inflation comes down and long dated bonds do well. Now, so far, because the economy has been very slow to fall into recession, I have got bits stuffed, frankly. But, I play the cycle, and reminder that I don't really class myself as an investor. I class myself as a speculator. I don't take, balanced views and have a balanced portfolio. I take big bets and I follow the cycle. Sometimes I'm 100% in oil. Sometimes I'm 100% out of equities like now, and in long dated bonds, which is, swings around like billy-o. And I expect to lose money when I get it wrong. And right now I'm losing money. So reminder to viewers, don't follow me with all your
reminder to viewers. Actually, Keith is very successful, but he, like everybody else, timing is really difficult.
Yeah.
So, just there's a caveat.
Yeah, absolutely. No buys, no sells. And actually, I thought this was interesting. So this is seasonality in the US 10-year. And actually, it tends to fall towards October. So this is the inverse of the equity market. The sell in May and go away.
Yeah.
So in the bond market, you buy in May and go away.
Well, fingers crossed for you, Keith.
Well, fingers crossed. So this is the main object of my speculations. So this is the 2068 index-linked gilt, which is very volatile. If you think of these things in percentage terms, it's selling off. This is data as of last night. It's selling off again today. But, I've had a hell of a week. That is the best part of 10%. So very volatile. If you look at it over the course of the past year, it started the year at best part of 220 and it bottomed this week at 80. If you exclude the shenanigans of getting around the trust mini budget. But if you look at it long term, so this is since it was issued back in 2014, this is a very volatile instrument, and that is why I'm so interested in it. So when inflation expectations were very low during the pandemic, its price hit over 325. So it is now at what's that? Best part of a quarter of what it was.
Yeah.
So it's down 75%. Now, I'm not expecting it to go anywhere near that, but I think it'll probably hit 150. So, if it's now 85, you're talking about a big potential return, which would be tax-free. And so I'm losing money at the moment, but as the economy slows, inflation falls, then I expect long-term dynamics to return to what they were pre-COVID. The world hasn't changed. We just had this extraordinary fiscal and monetary impulse, which was a one-off. And when that passes through, we go back to a deflationary world. So, and that's particularly true when the economy goes into recession, inflation comes down sharply, and then everyone panics and think deflation will last forever, which is what they do. So anyway, I'm not adding to it currently. I have been tempted to this week, but I have resisted, and we shall see. Watch this space. But currently I'm down on the year, underperforming Richard, underperforming the all share. But, during the second half, let's see what happens.
Indeed.
Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.